Hello everyone, and here we are, back with our next weekly lesson, now with a new name. Today we are going to learn more about the items which impact revenue in the income statement, discounts and returns. But before we start, let's briefly recap what we've learned already about the income statement. So, at the very top we record revenue. That's why it's sometimes called the top line. Below revenue we record the costs and taxes and arrive at profit and net profit. The profits are sometimes called the bottom line. And this way we are getting a simple income statement or P&L. Revenue is the start. What can happen with revenue? Very often our customers will ask for discounts. Why? Well, that could be because they are very good and loyal customers of us. Or they exceed certain volumes of purchases from us, after which the discounts are granted. Sometimes they can ask for a discount if they pay us earlier than the contract says. Time costs money, remember? Or we proactively offer discounts to boost our sales. So, discounts will impact our income statement. How are the discounts reflected in the P&L? To reflect the discounts, we would need to distinguish sales between discounts and after. For that, we could call our initial sales, which are based on the full prices, as gross sales or gross revenue. This will be the total we could get. Below them we would record discounts. They can also be called rebates or sales deductions, etc. The result we receive after deducting the discounts is called net sales or net revenue. And that's the number we use in our calculations of the profits. What do we do with the balance sheet? Yes, remember, always two sides of the transaction. On the balance sheet we will record net receivables, as this is the amount we expect to receive from the customers. Remember how we discussed that P&L reflects the history of our business? Here you see the example. Without P&L you wouldn't be able to see the amount of the discounts. If you look only at the balance sheet, you only see the net amount. When we grant discounts, they directly, one-to-one, decrease our profits. Our costs remain the same. So, we always need to consider whether granting discounts has a good commercial reason behind it. For example, if we want to win a new valuable customer. Another event that impacts our sales are returns. There can be various reasons for the returns, but they are also a normal part of the life of any retail business. Unlike discounts, which you record when you make the sale, returns are recorded when the sales already took place. Your initial sales are not impacted by them. Let's imagine we had gross sales of $100, granted a discount of 5, got net sales of 95, costs of 50, and the resulting profit of 45. Let's also assume we sold all the inventory we had and have only receivables left. Then, our net sales of 95 will have a corresponding entry on the balance sheet as receivables of 95. Let's balance our balance sheet with 95 in equity, for simplification. Now, our customer wants to return one apple which we sold for $20 without a discount, and which originally cost us $10. How will that impact our income statement and the balance sheet? Here we have two options. Option number 1. The returned goods cannot be resold and we have to scrap them. They no longer represent any value to our business. Shame, of course, but there is nothing we can do about it. How do we reflect that in our financials? We are introducing a new line into our P&L, returns, and reducing our sales by $20. Our net revenue and profits drop by the same $20, a one-to-one impact. Now we need to reflect that on our balance sheet. We decrease the receivables by 20, and as our profits dropped by 20, we also decrease equity for the same amount. And balance sheet balances. Let's discuss option 2 now. What if we can resell the returned goods? Then we cannot simply take them out of our income statement and forget about them. As we can reuse them, we can also reverse their cost from the income statement, as if we completely had not sold this apple in the first instance, no revenue and no cost. Let's remove $10 from our costs. This will be a positive adjustment. In this case, our profit drops only by $10, as compared to $20 when we had to scrap our products. Why? Because we didn't lose the value of the apple. What happens now with the balance sheet? On the balance sheet, the decrease in costs of 10 will be reflected as an increase in inventory. Remember where our costs are coming from? From inventory. Receivables will still decrease by $20, as we will receive $20 less from our customers. But the total impact on total assets will be only 10, and the same 10 on equity, and the balance sheet balances. Well done! We have learned another important accounting topic today. Let's summarize it. Discounts reduce revenue and profit in the same amount. Discounts are given to satisfy existing customers, to win new customers, or boost sales. Returns adjust revenue after the sales take place. If the returned goods can be resold, there is a smaller impact on the profits and value of the business. In our next lesson, we'll explore the unearned revenues. Thank you for watching the video. We hope this lesson helped clarify how discounts and returns affect the income statement. Don't forget to like and subscribe for more lessons on accounting and finance. See you next week!